Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, in a major breakthrough to the government's attempts to push through reforms, the Insurance Law Amendment Bill was passed by the Upper House in March this year. By this move, the government has amended the Insurance Act of 1938, the General Insurance Business Nationalization Act of 1972, and the IRDA Act of 1999. While on the one hand, this legislation has paved the way for global reinsurers to re-enter the Indian market, relook at it, and has increased the ceiling of FDI in insurance. On the other hand, it heralds good news for policyholders as well in terms of better pricing, product innovation and servicing. Now we have Yashish Dhaya with us, CEO and co-founder of Policy Bazaar with us to help us understand the nuances of the Insurance Amendment Bill and what it means for us. Yashish, welcome to the show. Now, it became almost a prestige issue for the government to show its resolve as far as economic reforms was concerned. The Insurance Amendment Act, increasing it from 26 to 49. What do you say? What is your take on that?
I think it had been in the news for the last 5-6 years that this particular bill was to get through, and finally it got through. And I think while we had the Congress government, the BJP was stopping it, and when we had the BJP government, the Congress was stopping it. But thankfully it's finally done, and I think as a nation it's good that something that was stalled for so long has finally gotten through.
So explain to our viewers what that really means. What are the highlights from the company perspective and also from the consumer perspective? I mean, does the consumer really benefit from 26 to 49? Because that's what has been highlighted. Okay,
so let's get into the very specifics. Let's look at a 30,000 feet view. The consumers benefit by insurance being there. If they have insurance, in the catastrophe events, the insurance can support them. And hence it's a very important part of nation building, of society building, of consumers having that final backup that I have insurance. So it's very important for insurance to be there. Now, insurance is also a very high investment industry. It requires a huge amount of investment upfront by the insurance company in terms of setting up all its processes, getting all the licenses in place, training all the agents, training all the distribution formats, getting its products out there. So before the first policy is sold, an insurance company can end up spending maybe 50 crores, 100 crores in just getting started. And so it requires a lot of investment. And that's the global view. So anybody who understands insurance knows that investment is necessary for this business. And hence, that investment was not going to be all available from domestic players. That investment comes from players who've got very sound understanding of this business from their global operations. And those people need to be able to invest to kind of make these businesses happen. And hence, I think moving from 26 to 49 was a long delayed item, which having moved is definitely a step in the right direction. That's where I would kind of leave it, yeah.
So is that the only thing? What are the other highlights of this bill which will directly impact the consumer?
Okay. So besides the 26% moving to 49%, which allows foreign investors to invest a little more, there are a lot of other factors that have changed here. Fundamentally, what's happened is a lot more power has been provided to the insurance regulator, the IRDA, to set up things like commissions that the agents can earn or the brokers can earn or different formats can earn. What the management expenses of insurance companies should be, what their solvency ratios should be, what investment amounts are necessary, and because the IRD has a strong understanding of the insurance regulation, I think that becomes quite a powerful area. In addition, what's happened is the councils, the General Insurance Council and the Life Insurance Council, have been given more stature. So they can call their meetings, they can have their voting, they can do a lot of other stuff independently. They've been given a lot of legitimacy in that manner. The reinsurers, and this is a very important part. See, real insurance is always, in a bulk of cases, is done by the reinsurers. So when you and I buy a life insurance policy, that's largely underwritten by the reinsurer. The company at the face of it is just selling the policy, really. It's created the policy and selling it. But a bulk of the risk is underwritten by the reinsurers. And these foreign reinsurers have for the first time been allowed to set up branches in India. What that implies is a lot of product innovation should happen because the reinsurers are the ones who actually take the bet on the risk. So you should see a lot more product innovation happening. Also, what's been authorized is multiple payment mechanisms have been authorized, Also, the policies can be done electronically now, so electronic policies have been authorized. What's also happened is there's a very specific clauses that are there. So there's one particular clause, clause 45, which essentially allows the insurance company cannot repudiate a claim after 3 years have
So
passed.
what you're saying is that it is kind of empowered the consumer in some ways.
Absolutely. See, when most people, when they bought a policy, their biggest question used to be, although I've always said it's not a very important question, but their biggest question used to be, is this company going to pay the claim? Now, if 3 years have passed on a life insurance policy, even if, and this sounds really odd, even if the customer has lied, the claim cannot be repudiated. So the claim must be paid. The company has 3 years to investigate and do whatever
so now the
it needs
onus
to.
is on the company.
The onus is on the company
disclaim, you know,
to identify if there's any misinformation within the first 3 years of the policy. If 3 years have passed and they have not identified that mistake, then the customer will not be penalized for it. The company would be penalized for it. I think that's a very important piece. In addition, what's happened is transfer of policies have been allowed. So you're allowed to kind of transfer policies from one person to another. That will not impact a lot of customers, but I think this claim repudiation piece is an important one. Two more things have happened. One is more emphasis have been given on what you would call some kind of a tribunal, some kind of when customers have a complaint with customers, that redressal format has been made stronger. It's been made more independent. And also the insurance companies have been given, in case they are unhappy with something, because obviously the regulator's got a lot more power. If they are unhappy with something, there's a statutory appellate tribunal which has been set up. They can always go to the SAT and sort of say, we're not happy with this particular decision of the regulator. Could you kindly ask them to review it? And the SAT will take its own view on it. So
what about the crucial aspect of mis-selling of policies and claims by the insurers?
I think the insurers have been made liable to any mis-selling by their agent. So far, the insurer could potentially say that, look, the agent mis-sold it and I'm not responsible. But now the insurance company is responsible, even if the agent has mis-sold the policy. So if the agent is making a miscommunication, eventually the company can be penalized for that.
So now IRDA has the right to impose a penalty of up to 1 crore.
Yes, so on the basis of. So essentially, there should be more emphasis on quality of business and quality of sales by agents. And there is, what one does not yet appreciate the flexibility which has been provided in the remuneration piece. I'll give you a very simple example. See, insurance is a complex industry. It requires a lot of effort in selling a policy. If you look at countries like the USA, the cost of insurance distribution is more than 100%. Even in many of the European countries, the cost of life insurance distribution is more than 100%.
So, I mean, what do you mean by that?
So, what that means is, if a customer is paying for 20 years, let's say 1 lakh rupees every year, then the cost of distribution is more than 1 lakh rupees. And I'm talking about developed countries, I'm not talking about India yet.
Right.
In India, if anything, the cost is less than that. Now, there's been a huge amount of hue and cry about agent commissions. The problem is not agent commissions per se. The problem is mis-selling, and that mis-selling is happening because the agent commissions are largely paid upfront. So I think having flexibility in managing this agent commission and kind of allowing it to happen over time is very important. The second very important aspect, which has not been very well addressed outside of the insurance circles or understood outside of the insurance circles. See, there were certain caps, etc., which were artificial. So there was a cap of about 30% or 40%. There was almost no distribution entity in the country which was able to operate within those. So people had, some setup here, there, and the other. Everybody had some setup. Now, the moment you try to build an organized business, it becomes very difficult with those setups. Because, you can have uncles and aunts kind of managing payments here and there, some cash payment here, something for something else. But that cannot be managed in a very scaled up manner. You cannot go and IPO your business on NASDAQ with those kind of arrangements. So, fundamentally, this flexibility allows the regulator to allow some of the organized businesses to start happening and start, building up businesses. So I think there's a lot of power in this flexibility, which is the Insurance Act of 1938 obviously 1938 is a long way ago, and things have changed since then. So having a change in it is positive.
Right. So from your perspective, and I was talking to you, and you were telling me that in some ways the insurance industry has been stagnant for the last few years. The number of policies being sold hasn't really increased as they should be, given the population that we have, given that, you know, economically we are totally changing, you know, from the agrarian to the urban setting. So, I mean, would that help now? Would this act really help make it more progressive?
The areas which I believe are the future are areas like health insurance, like motor insurance, like pure life insurance, critical illness, personal accident, etc. These were a very, very small component of the industry. So while these have grown rapidly in the last 7 years, so most of these businesses are at least double to triple of what they were. But because they were so small as a percentage of the overall industry, and what you call the investment cum insurance business was 80% plus, that insurance plus investment business has not grown at all or degrown in the last 7 years. Now 7 years I'm talking about 2008 onwards. So 7 years is a time frame in which the Indian GDP has probably gone about 1.6, 1.7 times, maybe 1.8 times. So as a country, we've almost doubled. The population has grown. Everything has grown. But those products have not grown. Because there's something fundamentally wrong with the way we were doing that business. However, at the same time, the positive side, which is being missed in the overall numbers, is health insurance has probably tripled. Term insurance has gone 20x. Motor insurance has doubled. So these products are growing. It's just they're a small fraction, so they don't have an impact on the overall. So as you look out 10 years out, you would see these products being a much larger proportion of the overall business, and the investment cum insurance products being a smaller component of the overall business. And I think the industry from here onwards should start growing, but you know, for some time we will have that lag effect.
So what about the innovation in terms of insurance policies? Is there going to be more innovation because of this? I mean, are new products going to be launched? I mean, how does it really change for the consumer?
See, if you really think about it, health insurance, I missed to mention this. There's a special category brought out for health insurance companies, which wasn't earlier there. You require only 50 lakh crore rupees to set up a health insurance company now.
And this provision is there in the amendment.
And this provision is there in the new act. And this provision is very important because it allows a lot of innovation in the health insurance industry. If you look back 5 years and look at the way products and processes were handled by the health insurance industry, there's been a remarkable change in the last 5 years. How many of us knew products where you had inflation beating products, lifetime renewals? What we were talking about was cashless policies. Now that cashless policies is something that started in about 2008. But what we're talking about today is all forms of innovation around the health insurance policy which make it useful for the consumer. Today we're talking about policies up to 60 lakh rupees. We're talking about super top-up policies. We're talking of real innovation happening there on the process side as well. I was speaking to the CEO of one insurance company that said they settled 96% of all cashless claims within 1 hour. Now, could we even think of that in 1996, in 2008?
So remarkable
progress innovation and progress. See, the fundamental issue which I've been debating for the last couple of years is that if the product is strong, then you will have growth and innovation. The problem is not about mis-selling or anything. The products are not strong on the investment cum insurance side. If they are not strong, then there is no way to sell them.
Then you don't have the confidence, the consumers don't have the confidence, they're not going to end up buying.
You cannot sell that product unless the consumer is fooled.
Right.
If the consumer is told the truth, there is no way he can buy that product.
So the Insurance Amendment Act, a step in the right direction.
Absolutely.
And a boost to the entire industry. We are discussing the Insurance Amendment Act, which was just passed by Parliament. Yashish, what about distribution channels? Before we take questions from our viewers, earlier the agents were restricted to one company. Does that change now?
So there is a new kind of distributor which has been allowed recently, and it's known as the independent marketing firm. Here what happens is an agent or a distributor can essentially sell more than one company, but two companies per category. So he can be selling two life insurance companies, two what you would call PNC companies or motor insurance type companies, and two health insurance companies. So overall he could be dealing with 6 different companies. and with the same agent. Now that gives a little more flexibility to the agent who was earlier restricted to 1 each. In addition to this, this particular agent is also allowed, this particular distribution format is also allowed to deal in mutual funds and a few other products. So it starts mirroring the independent financial agents of the UK, where you have these IFAs who deal in multiple financial products and they can advise the customer better. I think we're starting to move towards that open architecture. Maybe 2 may be the first step, and then they might increase it to 5, and then they might make it more like a broker where you can deal with as many companies as you feel like. So I think it's a right step. And one more thing that needs to be noticed, and this is the first time that you would have 2 regulators managing the same entity, because this same individual can sell mutual funds, which would come under SEBI, and then can also sell insurance products which come under IRDA.
As long as it doesn't lead to more confusion.
No, I think it's a good test case to kind of see how that relationship works out. So I think it's a good test case.
Right. Well, we've got your questions now. We've got Ashish. He's 39 years old and has opted for an insurance policy to cover his office building against possible threats. In addition to this, his bank that has financed his business has also insured his office property as well. He has 2 separate policies in force for the same property. Now, he wants to know if he will be able to claim benefits from both policies in the event of a claim.
No. So see, you can never claim more than your loss. So if your loss is, let's say, 4 lakh rupees, then you can claim only 4 lakh rupees. And if one policy is there for the 4 lakh rupees, you cannot claim on the other policy. If your bank has taken out a policy that covers, just see what the bank is covering and what you are covering. If you're covering the same thing, then it's not necessary. Then I would not advise you to have 2 policies to cover the same thing. It will be a waste of money. But at the same time, if it's covering buildings and you're covering contents or something of that sort, because I'm assuming that the bank has an interest in your buildings unless the bank is financing your working capital, etc. So just check that. Otherwise, no point having 2 policies with the same cover.
Right, we've got Samarth, who's an IT professional with an annual income of 3.73 lakhs. His monthly expense is about 22,000. He wants your advice, Yashish, on tax-saving instruments that he could look at apart from a term plan. He would also like to invest from a long-term perspective. His company is taking care of his medical insurance at about 5 lakhs per annum.
See, the first thing I would like to request Samarth is that while his company has taken care of his medical insurance, he could change jobs, and you will also one day retire. And India, there is a lot of disease. I'm not saying you particularly are going to fall sick, but the point is, statistically, a lot of people have got what you will call chronic diseases by the time they're 65, which is about the time when people retire, and hence they will not get a health insurance policy then, or they will find it very difficult, or will find a very restrictive policy. So taking a super top-up plan of a few lakh rupees, which will not cost you too much. So if you took a super top-up of 5 lakhs to 10 lakh rupees today, I think it will cost you less than 1,000 rupees a year. And that policy will ensure that the day you are 65, you don't have to undergo medicals to get your first 5 lakhs of cover. So I would certainly advise that you go in for a policy of that sort. If you're looking for investment, first of all, looking at your income, I don't think you need to invest for tax purposes. The breaks you are provided in the tax are sufficient, so you wouldn't actually need to invest. However, you should plan for your pension. See, most of the private companies are not going to be financing pension very well. So you should plan for your own pension, and I think ULIPs are a great way of doing that. You're about 30 years away from retirement, and 30 years is a great time. The markets might give about 200 times. The last 35 years, they've given about 200 times. So the point is, starting to invest in that in a systematic manner is a very strong thing. Whether you do that through ULIPs or whether you do that from mutual funds, they're both pretty much the same, because ULIPs are very low cost these days. The highest cost of a ULIP is about 2.25%. You're not allowed to have more cost than that, and that's pretty much the cost of a mutual fund as well. So I would really urge you to take on the ULIPs as a long-term investment category, should you wish to plan for taxes and also keep investing that into the future.
Right, we've got Deepak, and he has recently purchased a flat on loan and would like to insure his property. He wants to know how he can ascertain its true value. Also, he wants your advice, Yashish, on whether or not he must opt for a home loan insurance plan as well. What would you advise him?
My advice to him would be to take a term insurance instead. Therefore, there are 2 reasons for that. See, first of all, the home insurance plan is a good plan, right? So I'm not trying to hammer it in any way. But the cost of this plan is usually higher than the term plan. So if you would like to see what is the cost of a home loan plan for a 50 lakh rupee home cover versus a 50 lakh rupee term plan, you will usually find the 50 lakh rupee term plan is cheaper. And this is fundamentally because in the home loan, you usually take the home loan insurance from the person who's providing you the home loan. And hence, it's a bit of a related party thing. So your prices in such situations tend to be higher. Whereas people usually buy the term plan from an open market. So they'll go to an aggregator or they'll go somewhere where they compare plans and buy them. So the prices do tend to be a bit diminished. So I would say go for a term plan instead. That will obviously cover the home as well. In case an unfortunate event does happen, then if there's any excess amount that stays with the family, which can use it beyond the house as well. So I think that would be a better way of getting insurance than going for a home insurance plan.
Right, we've got Rahul Vardhan. He says he bought a house around 10 years ago for 20 lakhs. The current valuation of the house has more than doubled since then. He wants to know if he can have the appreciated value of the house insured, given that his house is currently insured at a lower, the older valuation.
Yes, I'm sure you can do that. But again, so you're looking for home insurance. Yeah, of course you can do that. So it's based on market value today. So you can ask the insurance company to kind of value it at a higher price and get the home insurance, the contents insurance for it. Absolutely. Sorry, the structural insurance for it basis that.
Thanks, Yashish. That's all the time that we have as far as our questions are concerned. But last week we asked you a quiz question, and the question was, does home insurance impact tax savings? The correct answer is no. And congratulations to Tina Jain. You won a gift voucher worth 1,000 rupees. Now, this week's question: when was life insurance nationalized in India? Was it in 1956, A, was it in 1973, or was it in 1999? Now send in your entries to queries@policybazaar.com and we'll see you next time with another show, Policy Bazaar. Thanks a lot, Yashish.
Thank you.
And of course, our Twitter address is twitter@policybazaar_in. And we'll see you next time. Goodbye.